You think $20,000 is about becoming rich? It is not. It is about finally having enough distance between you and disaster, so life starts feeling quieter. But there is a catch nobody talks about. The moment you reach this number, the system starts tempting you to spend it. Aisha remembers the days when every bill felt like a ticking bomb. One unexpected car repair, and her stomach would twist for weeks. But after rebuilding her emergency fund and watching it cross $20,000, something inside her finally let go. The background noise of panic faded. She could sleep again. This is not about luxury. It is about finally having enough space between you and disaster so your mind calms down. The perceived stress scale, a simple 0 to 40 measure, shows that most people stuck in survival mode score around 18 or higher. After reaching a real cushion, that number drops closer to 10. That is not just a statistic. It is the difference between waking up every morning bracing for the worst and waking up able to think about something else for a change. Bills do not disappear, but they lose their power to terrify. A rent notice becomes a hassle, not a threat. You can look at a surprise medical bill and plan instead of freezing. With the cushion in place, everyday decisions get lighter and faster. Behavioral data backs it up. People with a protected emergency fund make choices 27% quicker than those still living on the edge. Less time spent second-guessing groceries, less mental energy wasted on whether to fill the gas tank now or wait until payday. The true shift is not just about numbers. It is about no longer feeling hunted by your own expenses. Aisha describes it as breathing room, the first time in years she could stop scanning for the next crisis. That is the hidden value of the $20,000 floor. It is not a ticket to comfort. It is a shield against chaos, a chance to stop living at the edge. But this piece is fragile. The moment you treat that cushion as a reward fund, the old panic starts to creep back in. The real challenge is keeping that distance between you and disaster and refusing to let it close again. Aisha's breathing room isn't just a feeling. The moment her emergency fund topped $20,000, the world around her started to shift. Banks, which once charged her $12 a month for dipping below minimums, quietly lifted those fees. Her checking account, now flagged as premium, came with free overdraft protection and a higher interest rate, small changes that, over a year, added up to real money. But the difference runs deeper than a few dollars saved. That cushion changes how the system sees you. With a visible buffer, banks and fintech lenders start offering better deals. Suddenly, Aisha qualified for a personal loan at 6.9% APR instead of the usual 11%. If she wanted to take a course, the capital was there. No scrambling, no payday loans. A $2,000 tuition fee for a certification program became manageable, even routine. For the first time, she could say yes to an opportunity without worrying it would unravel her whole life. These perks aren't just for show. Banks set their rules by the numbers. Crossing the $15,000 to $20,000 line puts you in their affluent category. That means fewer hoops, less suspicion, and more room to negotiate. Even automated budgeting apps take notice. With the right settings, Aisha could lock her emergency fund with a second password, keeping temptation at bay and making it harder to dip into savings for non-essentials. The system rewards stability. Fee waivers, lower rates, and extra options aren't handed out at random. They are triggered by visible liquidity. That is why the $20,000 floor is more than a personal milestone. It opens doors the stressed and scrambling never even see. But every new benefit comes with a catch. The system gives, and it can take away just as quickly if that cushion slips. The peace and privilege that come with the buffer depend on holding the line. Let it drop, and the old rules snap back into place. Marcus hit his $20,000 cushion and felt the tension in his shoulders finally loosen. For the first few months, life felt lighter. Bills stopped feeling like threats. He even started sleeping through the night. No more 3 a.m. panic about rent or the next flat tire. But as the fear faded, something else crept in. Friends noticed his new calm and started inviting him out more. Dinners, weekends away, a few rounds at the bar. It felt harmless at first, just a little reward for surviving the grind. 9 months later, Marcus's savings had dropped from $22,000 to just over $4,000. The slide did not happen all at once. It was a slow leak, a trip to Vegas with old college friends, a new phone when his worked just fine, covering a sibling's rent just this once. Each time he told himself the cushion was there to make life easier, to finally say yes to things. But the distance between Marcus and disaster was shrinking. The old anxiety started whispering again every time he opened the banking app. Then his car broke down. With his balance already low, Marcus turned to a high-interest loan to cover the repairs. The annual percentage rate was 23%. Suddenly, every dollar he spent came with a new kind of weight, the kind that drags you back into survival mode, fast. He remembered the feeling of safety and realized how quickly it could vanish. The bank, which once offered him a low-rate personal loan when his balance was flush, now flagged his account for increased risk. The perks disappeared as quietly as they arrived. Marcus's story is not rare. The real danger comes after the milestone, when the urge to celebrate meets the subtle pressure to spend like you've made it. The cushion turns into a launch pad for lifestyle drift. Without guardrails, the breathing room that once felt permanent can evaporate in less than a year. The moment you treat that $20,000 as a reward, the old panic circles back. That's why the line between comfort and chaos is thinner than it looks, and why protecting the floor matters more than ever. Elena remembers the sting of watching her hard-won cushion slip away after a single rough year. She had made it, crossed $20,000 in savings, and finally felt the panic fade. Then she lost her grip. The slide started small, with a few impulse buys, a loan to a friend, and a vacation she convinced herself she deserved. By the time her car needed repairs, the buffer was gone. The old anxiety came roaring back. But this time, she rebuilt with a different strategy, not just saving, but locking the floor in place. The evidence is clear. Most people who protect their emergency fund do it by building walls, not just willpower. The first rule is keep your emergency fund in a separate account, not mixed with everyday money. That simple move makes a difference. In a 2-year study, 68% of people who kept their savings in a separate account managed to stay above the $20,000 mark, compared to less than half who did not. Elena set up a high-yield savings account, gave it a 2-step login, and stopped checking it every week. The money became invisible, there for true emergencies, not for every urge or invitation. Second, she set up automatic replenishment. Every paycheck, a fixed amount flowed straight into her emergency account before she could touch it. In fintech pilots, 71% of users who automated their deposits never dipped below their floor, even after big expenses. Elena treated the transfer like a non-negotiable bill. When she had to tap the fund for a medical bill, the auto transfer kept refilling the gap, quietly month after month. Third, she put a cooling-off period in place. Any withdrawal over $500 triggered a 24-hour delay, a built-in pause for second thoughts. Behavioral data shows that nearly half of would-be withdrawals vanish when people have to wait a day. Elena found that most of her old temptations faded with time. Naming the fund helped too. She called it her safety net, not vacation fund. That mental trick made every withdrawal feel weighty, not casual. A certified financial planner puts it bluntly: protect the floor first, lock the safety net before you chase anything else. Elena's story backs that up. With these rules in place, she held the line, and the breathing room returned. The difference was not in her income, but in the barriers she built between herself and the old chaos. The distance from disaster stayed wide, and for the first time it felt permanent. This isn't about wealth. It's about finally breathing instead of bracing. The real win is when bills become annoying, not life-threatening. But treat that cushion as a foundation, not a finish line. Because the moment you relax, survival mode waits just around the corner. What would you do with real breathing room?